Hi there. Colonies had no choice but to use the currency of the so-called mother country. Post-independence, some colonies continued using the currency of their former colonizer. On the other extreme, some countries chose to use the currency of their neighbor or a shared currency in the region. Whether formal or informal, these are known as currency unions. There have been many such currency unions throughout economic history. There are several that survive today, with the euro probably the most prominent. Others include the Eastern Caribbean Currency Union and the Common Monetary Area, which has metamorphosed several times in its history. So, what informs the decision to create a currency union? And what are the benefits or disbenefits of being part of one? These questions are the subject of our discussion today. It is also part 5 of the series on international currency markets. Before I continue, however, putting aside the possible political, social, and cultural reasons for creating a currency union, such as the euro, what are the economic reasons? The theoretical foundation for currency unions was laid by Mandel in his paper, A Theory of Optimum Currency Areas. Others have since refined the theoretical arguments further. As the theory stands, according to Wikipedia, there are 4 reasons or criteria that need to be met for an optimum currency area. These are, and I quote, labor mobility across the region, openness with capital mobility and price and wage flexibility across the region. This is so that the market forces of supply and demand automatically distribute money and goods to where they are needed. In practice, this does not work perfectly as there is no true wage flexibility. A risk-sharing system, such as an automatic fiscal transfer mechanism to redistribute money to areas, sectors, which have been adversely affected by the first 2 characteristics. This usually takes the form of taxation redistribution to less developed areas of a country, region. This policy, though theoretically accepted, is politically difficult to implement as the better off regions rarely give up their revenue easily. Participant countries have similar business cycles. When one country experiences a boom or recession, other countries in the union are likely to follow. This allows the shared central bank to promote growth in downturns and to contain inflation in booms. Should countries in a currency union have idiosyncratic business cycles, then optimal monetary policy may diverge, and union participants may be made worse off under a joint central bank, end quote. As an aside, in Mandel's paper, he also applied his argument to a single country, specifically the eastern and western regions of the United States, and similarly for Canada. Having discussed the theoretical foundations for currency areas, the next obvious question is, do the existing currency unions meet these requirements? As Mandel argued, this question is an empirical one. The second aligned question is, have the members been made better or worse off by their membership of the union? In a European Central Bank occasional paper titled, The Impact of the Euro on Trade, 2 Decades into Monetary Union, the authors, Vanessa Gunella and others, conclude that the euro has been beneficial for members. They say that, and I quote, the model results show that after the introduction of the euro, bilateral exports among the first wave of euro area countries increased by around 5.5% on average between 1995 and 2015, a small but significant positive impact. According to our estimations, bilateral exports between the first and second waves of euro area countries were between 4% and 6% higher after euro adoption. Bilateral trade among new euro area countries also increased, rising by about 5%, end quote. The waves in the quote refer to how countries joined the euro, with an initial group, that is the first wave, and a second group, the second wave. Consensus at inception was that the euro area did not meet the criteria for an optimum currency area, but there was belief that the introduction of the euro could facilitate this in a self-fulfilling way. In answer to the question whether the euro area had progressed sufficiently to meet the criteria of an optimum currency area, Gunela and others in the paper mentioned before say this, and I quote, "To the extent that the euro facilitates the emergence of global value chains within the euro area, the economic and monetary union can indeed be considered a key factor reinforcing optimum currency area endogeneity. The process of integration into a common currency area has allowed firms in the euro area to efficiently set up cross-border production structures and hence increase their international competitiveness. This integration has contributed towards increasing business cycle synchronization in the euro area, as shocks are transmitted through production chains. In this sense, the euro area has come closer to being an optimum currency area, as described in the seminal paper by Mandel and subsequent literature." End quote. Next, I want to look at the Common Monetary Area, CMA. I have chosen this currency union because it has some peculiar characteristics, as we shall see shortly. The CMA consists of Lesotho, Namibia, South Africa, and Eswatini. Historically, in previous incarnations, it also included Botswana. While the CMA is recognized as a currency union, it however lacks some key aspects of a classical currency union. 1. The CMA does not have a single currency for the entire area. Through bilateral agreements between South Africa and each of the other members, each member has its own currency, but the currency of the bigger member, South Africa, is legal tender in the other countries, while the other currencies are only legal tender in their own countries. These currencies are pegged one-to-one to the ZAR. 2. There is no common central bank, while the South African Reserve Bank SARB performs the task as a de facto union central bank. 3. While there is factor mobility, there are restrictions governing the access of the smaller members to the mature capital and money markets of South Africa. 4. There is no mechanism for fiscal transfers. For all intents and purposes, therefore, this is not a union of equals, but South Africa has a monetary hegemony within the CMA. However, in an IMF working paper titled "The Common Monetary Area in Southern Africa, Shocks, Adjustments and Policy Challenges," Jian Yi Wang and others conclude, and I quote, "The current CMA arrangements, although not a full monetary union, have delivered many benefits of a full monetary union. Available data through end 2005 show that real GDP growth in the CMA as a whole has accelerated over the last 2 decades, and real income per capita in purchasing power parity terms has converged, the gap between the richest country, South Africa, and other member countries having narrowed. Thus, the CMA experience so far has provided affirmative answers to the two main objectives: the sustained economic development of the CMA as a whole and the advancement of the less developed members of the CMA. The CMA arrangements have facilitated regional integration. Inflation in the CMA has been lower than its neighbors in the SADC. Similarly, interest rates in the CMA are lower than in neighboring countries in Southern Africa. End quote. The SADC is a regional trade grouping including all countries in Southern Africa. Some concluding remarks. 1. The CMA is almost perfectly mirrored by the oldest customs union in the world, the Southern African Customs Union, SACU. I say almost perfectly because Botswana, which, as I previously indicated, is not a member of the CMA, is however a member of SACU. Therefore, taken collectively, the CMA and SACU exhibit the characteristics of an economic and monetary union, with Botswana's situation akin to that of Britain pre-Brexit. Although peculiarly to my mind, the members have never sought to consummate this economic and monetary union. 2. The South African currency is legal tender in Zimbabwe, along with the US dollar and pound sterling. So clearly, Zimbabwe is a de facto member of the CMA, and of course of the sterling currency union and the dollar currency union, and yet has not joined formally. Those who are familiar with the regular hyperinflation in Zimbabwe and the consequent loss of status of its currency, even among its citizens, would understand the clear benefits that Zimbabwe would reap from either formal adoption of the ZAR as its currency or a new CMA currency, and the discipline and credibility of the SARB or a new CMA central bank. 3. The introduction of a CBDC in South Africa that has no restrictions on foreigners holding it could exacerbate the effect of dollarization in the smaller members of the CMA. Dollarization or currency substitution is the phenomenon of residents of a country to have holdings of assets denominated in a foreign currency, or to prefer to transact in a foreign currency. This dollarization may be official or unofficial. To the extent that the ZAR already is legal tender in the other member states, unless otherwise decided, it is safe to assume that a ZAR CBDC would also become legal tender. The dollarization could be substantial, especially if the ZAR CBDC were to be issued first or be perceived by residents of the other countries as superior in some way, for example, better security features, and so on. So therefore, the member central banks would have to take steps to synchronize their design and timing of their respective CBDCs to avoid this problem.